The stock for Plug Power Inc., or PLUG, is currently trading at $3.40, reflecting an intraday movement of minus 2.15%. That small fractional slip today, settling back toward the lower end of its recent range, is almost a mirror image of the market's constant push-pull with this stock. The surface-level expectation is that Plug is simply a hostage to broader interest rate shifts and the cyclical hype around green energy, a highly volatile name that swings wildly on a headline about government funding or an analyst upgrade. However, the reality we need to focus on, the part that cuts through the noise and is often missed by retail investors focused on the stock price chart, is the quiet, grinding work being done on the balance sheet and cost structure. The company has been laser-focused on moving away from its reputation as a chronic cash burner by aggressively chasing operational efficiencies, particularly within its fuel margins. We're not talking about a press release about a future project. We're talking about real, on-the-ground cost discipline that, if successful, fundamentally changes the future profitability profile. And that's the insight that should hold your attention. The general belief about Plug Power stock is that it's the ultimate pure play in the hydrogen economy, a high beta bet on the future of green fuel, one that will either go to the moon or struggle to ever achieve consistent profitability. This narrative is based on their spectacular past price swings, a massive run-up a few years ago followed by a punishing correction that saw the stock shed a significant portion of its value from its highs. Many investors, particularly those engaged in self-investing on platforms like Robinhood or SoFi Invest, treat it almost as a meme stock for the industrial clean energy sector, trading on hope and future potential rather than current fundamentals. The challenge to this belief lies in the distinction between their technology potential and their execution reality. The reality is that the company has now moved into the very difficult, capital-intensive phase of constructing and operating large-scale green hydrogen production facilities. Opening their Georgia liquid green hydrogen plant, for example, which is the largest of its kind in the U.S., is a milestone. But the associated ramp-up costs and the logistics of securing reliable, cost-effective, renewable electricity for these sites are what currently pressures the gross margins. The latest reports reflect this tension. While revenue has been growing, primarily driven by their core material handling business and electrolyzer sales, the net income loss remains stubbornly wide, forcing the company to continually manage its liquidity, including utilizing warrant exercise agreements to secure hundreds of millions in capital, which, while necessary, causes shareholder dilution. This dilution is a constant headwind against any positive news, a stark reminder of the massive gap between the theoretical potential of hydrogen and the high price of its commercialization. Looking at the most recent stock movement, the action is defined by a pullback from a sharp upswing that occurred in late September and early October. This surge was less about a single piece of company news and more about a sector-wide momentum fueled by renewed optimism for government support for the hydrogen investment. Specifically, there was positive sentiment following a key analyst upgrade that significantly increased their price target, citing the company's progress on cost reduction and the long-term potential of their electrolyzer business, which is the core component for generating green hydrogen. This movement demonstrates a classic tension between technical trading and fundamental reality. The technical traders on Fidelity's trading platform or an Interactive Brokers account see the volume spike and the breaking of key resistance levels, pushing the stock higher on pure price action. The fundamental reality, however, is that while the analyst target moved up, other firms, including Morgan Stanley and BMO Capital, have maintained or reiterated cautious sell or underweight ratings, keeping a much lower price target and explicitly pointing to the sustained cash burn, which is a massive red flag for any growth company. The fact that the stock is now dipping again, pulling back from its recent high of $4.58, suggests that this fundamental caution is starting to reassert itself as traders take profits, and the market waits for the next genuine, tangible improvement in financial results, not just another future-looking projection. The sheer trading volume here is also notable, often exceeding its average, which indicates high speculative interest. This is typical for companies in capital-intensive, future-facing sectors where the intrinsic value is so difficult to calculate based on present-day earnings or lack thereof. Institutional activity, which we track closely, shows a mixed picture. While giants like Vanguard Group Inc. and BlackRock Inc. maintain large passive positions through index funds, reflecting the stock's inclusion in various ETFs, the more active, discretionary institutional investors have been highly volatile, with some notably increasing their positions, while others, like Norsebank, made a massive reduction. This isn't institutional confidence, it's a deep split in opinion, where roughly half of the sophisticated investment community is betting on the long-term green transition narrative, and the other half is focused purely on the immediate, challenging financials. This is where active investors, maybe using tools like Schwab Intelligent Portfolios or a comprehensive platform like Fidelity Investments, need to look past the top-line volume numbers and see the contrasting moves beneath them. The recent insider trading data offers a small but interesting counterpoint. Plug Power's financial officer made a significant purchase of shares, which is often seen as a sign of insider belief, but it's a small drop in the massive ocean of institutional flows. Now let's zoom out to understand what Plug Power actually does beyond the ticker symbol hype. At its core, Plug Power is an integrated provider of hydrogen fuel cell systems and the related green hydrogen ecosystem. Their business isn't just one product, it's segmented into three primary areas. First, there's the material handling segment, which is their established bread-and-butter business. This is where they sell and service hydrogen fuel cell systems, known as GenDrive, primarily to replace lead-acid batteries in electric forklifts for large customers like Walmart and Amazon. This provides a relatively stable revenue. Second, they have their electrolyzer business. Electrolyzers are machines that use electricity to split water into hydrogen and oxygen. This is how they create green hydrogen when powered by renewable energy. This is arguably the future growth driver, where they sell the hardware to other companies or use it in their own plants. And third, and perhaps most critically, is their hydrogen fuel delivery business. They aim to establish an end-to-end green hydrogen supply chain, from production at their own plants, like the one in Georgia, to liquefaction, storage, and dispensing. The goal is to control the whole value chain, which is what allows them to target profitability by lowering the cost of hydrogen fuel, their single biggest margin detractor today, because they've had to buy high-cost gray hydrogen from third parties to keep their material handling customers running. Historically, this business model has been a financial struggle. The costs associated with building out this massive capital-intensive infrastructure, the manufacturing facilities, the hydrogen plants, the logistics network, have kept the company deeply unprofitable. The quarterly reports over the last few years have been characterized by significant losses, high operating expenses, and a clear and present need for more capital. For example, their gross margin has historically been negative, meaning they were effectively losing money on every unit of product and service they sold, though recent efforts have shown some sequential improvement. This lack of profitability has required frequent capital raises, leading to the aforementioned dilution, a pattern that makes traditional valuation metrics like P/E ratios meaningless, forcing analysts to use future enterprise value to sales multiples, which are inherently more speculative. Shifting our focus to the future, the expectation is that government support, primarily through incentives like the Production Tax Credit and Department of Energy loans, is the primary catalyst that will finally push Plug Power into the black. The reality is more nuanced. Government incentives are necessary, but they are not sufficient. The real opportunity for Plug Power lies in the successful execution of its operational strategy, specifically its ability to ramp up its internal green hydrogen production and significantly reduce its reliance on higher-cost external sources. The company has stated its goal is to exit 2025 with a positive gross margin run rate and achieve EBITDA positive in the second half of 2026, leading to overall profitability exiting 2028. This is a clear, tangible target that investors should measure them against. If they hit those milestones, the stock price reaction would be profoundly positive, as it validates the entire thesis of the hydrogen ecosystem. However, the risks here are immense and multifaceted. The first is execution risk. Building and commissioning complex chemical plants and industrial-scale electrolyzer systems on time and on budget is extremely difficult, and delays have been a recurring theme in the industry. The second is competitive risk. While Plug is a leader in proton exchange membrane fuel cells, other forms of hydrogen technology exist, and large, well-capitalized players like Cummins and industrial gas giants are also building out their own hydrogen capabilities.